Hey everyone, welcome back. Happy Tuesday. Hope you guys are having an awesome day. Today is Tuesday, July 11th. This is Drawbridge Finance. My name is Levi Woods. As always, this is just my personal opinion. I don't offer financial advice in any way, shape, or form. So trade at your own risk. The market is doing some sideways action today, and we're going to jump right into this. If you guys could do me a favor and leave a like or a comment, that would be fantastic. I would love to know where you're watching from. So join in, let me know where you're watching from, and I will jump right into this. I've got Options AI up on the screen this morning, looking at EA, which had a big up move over the last night, and coming down today. I put on a little bearish play on EA earlier today. Cleveland Cliffs up 2.8%. These are just things that I have kind of on my radar, looking at some individual stocks, looking for some plays. And of course, if you guys are interested in joining and seeing any of my trades live, you can head over to Patreon. This is patreon.com/drawbridgefinance. If you just type up here, find a creator, you can just type in Drawbridge Finance and it will come up here with my name, Levi Woods, creating videos in stock investing, about stock investing and option trading. Now, Patreon has recently made a little bit of a change, and they are trying to encourage people to follow along, but they've made it pretty hidden. If you go over here, if you want to follow along for free, you can get posts for my live streams, things like that, any of my free content that I offer on Patreon. If you just click on this little button, this little three dots over here, you can hit follow, and you can actually follow for free if you're not ready to sign up. I know there's lots of traders that have smaller accounts and they're not necessarily trading live, but they just want to get notifications of my live streams and they want to be able to join in on all my free content. That's how you do it. So again, patreon.com. There's I pushed the wrong button here. I'm gonna see it here in a second. The web address is down at the bottom, patreon.com/drawbridgefinance. And again, clicking on that little follow button will give you that information. Okay, there's 16 people online, which is fantastic. If you guys could, again, let me know where you're watching from, it would be great. And if you have any specific stocks you want to talk about, I don't know why that's not working. If there's any specific stocks you want to talk about, please let me know in the comments here on YouTube, and I will get to those questions. Otherwise, let's get into a couple of things that we're looking at in the market in general. I've got IBKR open. Looking over at this window here on the right, we've got the VIX marking at 14.89, SPY up 0.32% today. So is the SPX, obviously. SPY is the ETF that a lot of people trade. SPX is the index. This is typically something I trade my zero DTE trades on. Today's zero DTE trade was quite successful. I made my $250 profit on a single contract just in the first hour and a half of the market open. So very, very quick, little easy trade to make a couple bucks to start the day. QQQ marking right now up only 0.12%, and oil marking at $74.71 a barrel, up 2.36% today. IWM is the big mover of the day, up 0.6%. That's the Russell index. And yeah, that's about it for the little market recap. Jacob is watching from Australia. That's amazing. Is it the middle of the night there for you guys? I've traded in Australia. It's a bit of a tough time zone for me to trade North American markets. Lithuania, Valky, I don't know if I've seen you here before, Valky, so welcome. Thank you very much and for joining. And David is joining from Pasadena, California. Awesome to have you guys here. I'm on the west coast of Canada, so I'm in the Pacific Standard Time. This is still only 11 o'clock in the morning for me, so I'm typically done my day by 1 o'clock, and I get to enjoy the rest of the summertime fun. One of the things that I want to look at right now is a little trade called the honey trap. I've kind of gone over this a few times, and it's a trade that I keep continually putting on because it's got a built-in hedge into it. So I'm going to go to the August 18th regulars. We're looking at DocuSign. I'm just going to change this over to SPY, and we'll take a look at the potential setup for a honey trap trade. So honey traps are pretty basic trades. Again, I'm going to click on August 18th. So I'm looking 8 days to expiration. And what I'm doing with this is I'm looking for a credit collection. So typically on SPY, I trade these about $5 wide. This is a bull put spread. This is a bull put spread right here. A single one marks at about 50 cents. So the idea with this trade is that I would actually place this trade like a ratio. So I would do 3 bull put spreads for every 1 bear put spread that I put on. So I'm going to do a $5 wide bear put spread. And the total credit collection for this, we're looking for like a decent amount of credit. So right now with the VIX being as low as it is, we have to go fairly tight on these. But typically the short strikes are anywhere between the 10 delta and the 20 delta. These are all puts in this case. And this little trade, if we're looking at this, could actually be filled right now for a credit of 53 cents. Now, if we look at the profit profile and what happens at expiration, this has a little bear position in it. So again, very small profit window, max profit window between 424 and 426 on SPY, but it's got this very high probability of profit, 90%. The reason for that is because the trade starts as a credit, which means that if all the puts expire worthless, then I get to just keep whatever credit I've collected. Now, in this case, the max loss is about $850, and I'm collecting a credit of just over $50 minus some commissions. So the expectation, if SPY continues to rally, is that I'll make $50 on an $850 max risk. Now, from percentage-wise, let's grab the calculator and just take a look at what that return is. Where did my calculator go? There it is. It's on one of the screens. So we're going to go $50 return divided by $850 risk, and that works out to a 5.8% return. That's if the S&P 500 stays above 430, or SPY stays above 432 for the next 38 days. Let's look at the probability of that happening. I'm going to go over to Options AI, and this is one of the services. This is a paid service, and it is absolutely fantastic. It pulls and charts real-time data based on the option chains, and you can see how quickly this actually works. So I have to click on this 3-month range. We're looking at the August 18th, and you can see right here the expected move right now with the IV being 13% is 2.9% from the current price, which would put the ETF somewhere between 453 and 428. So let's go back to IBKR and see what would happen if this stock was trading at those two levels, 428 and 453. I'm just going to zip back over here and, oh, lots of screens over. So 428 is right on the profit slope. So if it was to go down there, this trade could actually make around 440 bucks. We would actually want it to slip a little bit further down and actually be below 426. But if it did go to 428, which is the expected move, this would make a $400 return. Again, on $850 risk. So if we do that math, we would profit, the total profit would be 441 divided by 850 risk. So the trade has a potential of making 51% return if it was to close exactly at 428 on the expiration day of August 18th. If it goes up, obviously, to 453 or any price above, then I've just made a 6% return on my money. So, of course, the downside to this is that there is a max loss of 100%. I could lose $850. So these trades, if the market moves against us, can be very, very costly, and we don't want to put on too many of them. But if we layer them up, we often get a very, very nice yield curve. We get this downside protection, and we can play this trade relatively small because it is a limited loss trade. So that's the setup of a honey trap. Terry Mahoney's in Thunder Bay this week. That's pretty awesome. I hope you guys are having good weather. We had a little bit of rain this morning, but it's lightening up, and I'm going to get out on the paddleboard this afternoon, which is going to be amazing. Can't wait for that. Kevin, always joining us from Lakeland, Florida. Appreciate you joining, Kevin, always. Flatten, hi Levi, Chewy for honey trap. Any thoughts? Yes, absolutely. Let's look at a trap on Chewy. And so I'm just going to go up here and type in Chewy. I haven't been playing Chewy very often. Where not as of late anyways. What is the stock action like? So we can see these moving averages on screen. looking like we're seeing a little bit of sideways movement. Obviously in May, we saw these lows around $29. Let's scroll back just a little bit. So we saw, you know, some support down at $29, going back to September of 2022 and May of 2023. So there's definitely a low valuation here that looks like it's got some decent support after Chewy obviously has come way down off of its highs. You can see this moving average coming from prices that were much higher. Let's look at what Options AI has to say about Chewy. We'll also find out. You guys need to email me. There's my email address. You can always send me an email if you've got questions. I'm willing to answer any of those questions you may have. So it doesn't have to be limited to these live streams. Okay, looking at Chewy, let's go, where are earnings? So earnings are going to be August 28th, which is coming out way late. So even the August 25th is got a very nice expected move. So here we go. IV is 45%, which is great, and the expected move is 11% from 38.64, meaning that the range on the bottom side is around 34.39. Let's take a look at see if we can place a honey trap that will capture that potential move, 34.39. So I'm just gonna go back over here. We're gonna go to August, and the strikes are super tight on this, so it's going to be difficult because they're not dollar wide in this case. So I should start this at the top. Let's keep it clean here. So I'm going to be doing the bull put spread at the top, 3 of those. We're going to be buying a bear spread, and the width of this I think is going to make this pretty difficult to get in, but we will see what the price action is like. There's enough volume in here that I'm not worried about poor fills, but you can see that with this particular trade setup, I'm actually opening for a debit in this case. So now there's a couple of things I can do. I can either increase the number of contracts, so I can do a deeper ratio, or I can change the width. If I change the width, I'm doubling the amount of risk. So on the bull put side, I would be taking now $1,200 in risk to potentially make $250 if the stock was trading between $32.50, $35. I would now be entering this for a credit of around 15 cents. 15 cents is not a huge amount, but it is definitely enough to make this trade viable. It's not quite 1% after commission, so I would probably switch this up for a different type of trade. So let me just see what the risk is if we do a 4-4. So these are just variations that we can do to try to see if we can squeeze this credit out. This is 13 cents, and I've increased the risk by about $250. Every contract that I add, there's more potential. Now, since the expected move is around 34.29, I may not have to go as low as this 32.50. So let's do a slightly different trade. Let's change the 30 puts to 2 contracts, and then the 32.50 to 3 contracts, and then I'm going to not sell this 35. What this does is this creates a 132 butterfly. In this case, it would be a debit to open, which I don't love because now I have risk to the upside if the stock moves up. Obviously, if there's a down move in the stock, you can see even today, this trade would make some money. So there's benefits to both. If I thought there was going to be a move to the downside, there's a very cheap way to get some short deltas in this case, and with very little risk. I could risk $80 to potentially make up to 400. Butterflies can be very lucrative that way. What I'm going to do is slide this down to the 35 and see if I can get this in for a credit. Now this position I am liking quite a bit. So we've got still a substantial amount of risk on here, $700 in risk, with the potential of making up to $300. The credit to open would be well over $50, which is very nice. And all of a sudden I'm in a position where I could quite nicely make a decent profit. I could also roll this a little bit tighter, reduce my risk even further. This one is still, bounces back to that 13 credit. So, you know, a little bit of playing around with these, but you can definitely skew this into your favor however you like. Let's just split these apart and sell a 32.50 contract. So I'm keeping that similar ratio. So I've got 3 longs and 3 short, but now the 3 shorts are at different strikes, and you can see this profit tent that it creates. So now I've got $500 in risk that could make up to $250. 88% likelihood that we're going to make money. The opening credit is a little bit light, 15 cents. So I think my preference here would be to do that 132 with the 35 put. This would be my preferred trade if I was looking to put on a trade today. Break even at 34.49. Obviously, if there's a down move right now, this does have a positive delta. Positive delta showing right here. So that means that it does lose money as it moves down. But what we actually want is for it to move down slowly over time and end up in this profit tent on August 18th. So this is the type of trade, if I'm looking to hold to expiration and I think there's a good chance that it could be trading above 33.49, then this is the type of trade I might consider putting on. Let's just zip over to, let's look at it on Trading View, and 33.49. I'm just gonna mark that on here, 33.49. So that's going to be the break even. So if I thought that the Chewy was going to stay above this price, then this is a trade that I can consider placing, because it makes money as long as Chewy's above that price. So that's the way I like to set up kind of complex options that decay slowly over time. Jimmy Traders, hi, Levi watching from Niagara. Your XOM strategy selling and at the money put, won't that get assigned? Is that what you're looking for with a trade like that? Okay, so specifically asking about XOM, let me show you a little bit about assignment, because when there's a bit of math that I think the traders need to learn. Did I just close that? That was a mistake. Give me 1 second here. I never do that option chain. I usually minimize things. We've got the option chain. So I'm going to go over to Exxon. The question is this 105 put. Now, assignment risk is a bit of a tricky thing. So where is my XOM trip? My transaction date was the July 6th, and I actually have the July 21st 105. So let's go and look at my current position. My current position is the 105 put. Now, is there risk that the market is going to assign me this share and force me to buy shares at $105 per share? There is not. Now, this is just a logic equation, because if I was the market maker and they wanted me to buy shares, they would be better off selling them to anyone for $105.89 rather than forcing me to buy them for $105, which is less than the current market value. Now, this wasn't the case when I put this on. When I actually placed this trade a couple of days ago, the stock was trading at 103. So that put that I sold was in the money. But there's also some extrinsic value. So let's pretend that we're talking about a position that is in the money. Say I was looking at selling the 107. Now, what is the assignment risk on this case? Now, the market maker is paying me a value today for this position. If I enter this 107 put, I actually collect $2.05 to enter this trade. So if we get out our trusty calculator, where did my calculator go? If we get out the calculator, if I was to be forced to take assignment on this trade, the market maker would be collecting $107 per share from me. But they would lose their long contract. They would be exercising their long contract. And that long contract actually has a value of $205 right now, $2.05 a share. Because of this, there is no way that they will assign this share. And the reason is because it makes more sense for them to sell the contract that they own and collect $2.05, and then sell the shares that they have in their account, which is 105.9, and their total profit today, or their total credit by selling the long put and selling the shares in their account, is 107.95. So they would be giving up 95 cents in extrinsic value by assigning the shares. Because if they exercised their right, they would only get 107 instead of 107.95. So as long as there's extrinsic value in the position, there's generally no assignment risk. Now, that with a call, shares can be called away from us, but generally we don't get put shares in our account unless there's, even with a dividend. It's unlikely that we would be put shares in our account. We were more likely to have them called away. So there was little risk when I put on this trade because I was bullish on XOM when it was trading down at 103. I thought it would go up, and what I wanted to do was the simplest trade possible that allowed me to make some money if the stock went up to 105. By doing that trade, I collected $265. And in the next 10 days, as long as the stock stays above 105, it is going to expire worthless. I won't have purchased any shares. I'll just have made $285 for agreeing to purchase them for 105 when they were at 103. I have absolutely no problem selling in the money puts as long as there's extrinsic value. The hack, the little cheat that you can use, is just look at the call side. We know that the 112 put will have the same extrinsic value on the call side and the put side. So this 112 call has 13 cents of extrinsic value. Therefore, this 112 put has 13 cents of extrinsic value. If we were looking at the July 14th and there was no value, if I had the 110 put, this would definitely be at risk of assignment because the brokerage would only be giving up 5 cents to assign those shares. But I could hold the 107 even with only 2 days left or 3 days left, and there's no way that the brokerage is going to give up 50 cents in extrinsic value just to assign my shares. They make 50 cents more if they sell their long call and they buy the shares, if that's what they want to do. So there's no way that I'm at risk in doing that. This is why I trade close to at the money positions, because there's extrinsic value and very little assignment risk. So hopefully that helps your understanding of that, Jimmy. GV, how long do you hold a honeypot for, and how do you typically get out if it moves in the wrong direction? Do you leg out if you can't sell the opposite contracts to close out all those legs? Yes, you can leg out. It is 2 trades. A honey trap is 2 trades. So if it does move against us, then I've got 3 bull puts that are losing money. I want to close those as soon as possible. It depends on the direction of the move. If I believe that the market is going to continue to go down, then I close the 3 bull put spreads, the bottom portion of the honey trap, as quickly as possible, and I leave the bear put spread to run its course, because then I'm making maximum profit if I wait to expiration. It definitely depends on the extremeness of the move. When you look at any of those positions, the curve is relatively flat. I mean, the honeypot we looked at had a 20 delta, so it's not moving in a massively extreme way. Remember, if we have stock, we have 1 delta to either direction. So if the stock moves down $1, a long stock position would lose $1, but this honey trap is only losing 20 cents to the downside, likewise making 20 cents to the upside. So those moves have to be fairly extreme. Oftentimes what happens is they just drift down, and that's what we're actually trying to capture, is we want a couple of wins. So that honey trap is specifically a trade where we have to collect enough credit to make it worthwhile if the market goes up, and we have that assumption. It is a bullish trade by nature, so I want to make the money on it going up. On the way down, it depends on the extremeness of the move. If it's just drifting, then that's actually what I want, because that's when I'm most likely to realize max profit. But if it moves down rather quickly, then I'm closing the three bull put spreads at the bottom, and I'm opening up, I'm leaving the bear put spread in play, because it does have a hedge. Again, playing small, layering these up, and playing with them when volatility is high. Volatility is not super high right now, so I haven't actually been doing SPX trades or SPY honey traps. I've been playing them on the Russell instead, on RUT, which is cash settled and has no assignment risk if there was an early move on those trades. I like to hold them as long as I can. If the move moves to the upside, if we get an extreme move in the beginning, I actually made a couple of adjustments today where I took off all the downside risk, because if we start with enough credit, then it's easy to close that bull put spread. Even if we close partial contracts, you can just continually reduce the downside risk. And what you end up with is a free bear trap. So you have a bear put spread in play that you're not intending to make any money off, but if there is a sell-off, those ones just kick in and you make a couple $100, which is pretty nice. So, and we can layer those on. There's certain stocks that work quite well, but typically anything that has a spike or a very, very small profit range has to be held close to expiration. So you got to play with the expiration dates, and I tend to layer all of mine on. So I have multiple trades on. So if I have a Russell expiring in 9 days, then I have one in 21 days, then I typically have one in 24 days, so on and so forth. So I have like multiple ones, multiple strikes, all kind of working together, and they layer up nicely. Hopefully you guys have some other questions about some specific stocks. We can pull them up in Options AI. We can look at them in Seeking Alpha, which are a couple of the affiliate programs that I am involved with. And they're pretty great little things. One of the things I want to look at is, let's look at the top stocks on Seeking Alpha. Oh yeah, RMTI still rocking right at the beginning here, 572. Boy, that move has been extreme. I got out of this trade. I took a nice little win when the stock was down around 270, took it up and made a very decent profit when the stock had the move to the mid fours. I didn't think it was going to continue to climb after that move up, so I exited with a profit, and it still is topping the charts on Seeking Alpha. I don't know how much steam this really has, this particular stock. As I said, I got out and didn't leave anything to roll further. Let's see what else, if there's anything else in here. Delta Airlines obviously having an extremely large move. All the airline stocks, United in here as well. These prices have moved up quite a bit. Host, I've looked at a few times. I haven't been able to put in a trade. What else do we have in here? Just taking a look and seeing if there's anything new that I haven't noticed on here before. No, there's a lot of different trades. IQ, I have a long position on, little Chinese Netflix type stock. So that is one of the things that we can look at. Would love for you guys to ask some specific questions about specific trades. Otherwise, we can zip over and I will take a look at just what is going on in my screener, see if there's any opportunity. It is an up day today, so it is not as exciting as a premium seller. You know, normally I want to sell when the VIX is elevated, and when the market is down, that's generally when I open most of my trades. We do have some softness in tech. This may have to do with the new reorganization or revaluation of the NASDAQ 100, which is going to happen. So the QQQs are going to reevaluate their weighting, because we basically have 7 stocks that cover most of the index. So that is going to change that, and that change happens on July 24th. So I'm not actually sure how that's going to affect the price of the Qs in general, but I know that the reaction to that is we have seen a little bit of softness in some of the bigger names. So we've got Apple down 0.9% today at 186, Amazon up today, but trading at 128. It's been in a range for a while and hasn't moved up to its all-time highs. Google trading down at 117. This again was down a little bit from 123 after the announcement of that move. We've got Meta trading at 295. What does Meta's chart look like? This is another one that I don't trade all the time. Boy, just churning upwards. So that trend in Meta continues to just go bonkers. Lots of talk on the internet about Tesla, Elon Musk, and Mark Zuckerberg and their little threads. Competitions, let's say. I hope everybody saw the tweet from Elon. Pretty funny. I will see how that plays out in the long term. I love when people just like go for it on the internet. Not really my style. I don't like to call people out like that. I'm more of a let's take a look at the numbers and see how it works out, rather than having dick measuring contests. I don't think that's very appropriate, but pretty funny if it's at all true at all. What else do we have? Microsoft, we're looking at 330. It's been softening these last couple of days, and we'll see if there's some support in here. We've had a pretty big move to the upside, so there's a good likelihood that this could trade sideways. I think that with many of these tech names, I'm looking for sideways movement in the shorter duration, especially with this announcement, which is now 13 days away. Jimmy Traders, Upstart, July 28th, 38, 30, 75. All puts. Okay, thanks for clarifying the all puts. So long, okay, let's pull up Upstart. Upstart's one of the ones that I have been trading for a while. This move has been fantastic for me. I've been moving my short puts up. Made quite a bit of money on this particular trade. This is a great company, and I think that they're going to continue to be at the forefront of a stock that has some volatility for sure. So this is definitely one of these trades that we could see the stock come back down, but we could see it continue to rise as well. It was marking above $44 earlier today, and now it's pulled back to 42, actually a pretty small candle after a pretty big green candle yesterday. But let's take a look at the options chain and see what is going on. So why is this not linking? Which one do I have off? Let's group that together. Click on Upstart. And hopefully that will trigger that. Okay, so we are looking at the July 28th. When are earnings on Upstart? We're getting into earnings season, so we have to be really aware of what is going on with these expected moves. We don't see anything major until August 11th. So July 28th, we're looking at an expected move of 35.86 to 48.74. I'm assuming that whatever trade Jimmy posted is not going to have any upside risk on this because of the trend and the ridiculously high stock price that Upstart is coming from. It was trading above $300 at one point, so there's massive potential to the upside if it does start to really go. So 35.86. Let's take a look at this trade that is being talked about right now. So I'm going to clear everything off, and we're looking at July 28th, the plus the 38. We're going to minus the 37.50. So that's a little bear move. 2 times the 37. Oh, are we doing this is like a honey trap setup. Something like that, looks like. And then plus the 36. And we did 2 of these guys. So I'm going to change the quantity here to 2, selling 2. And then buying a 35.50. I love the complexity of this. This is always fun when you got like really mash it in there. All puts, credit of, so we've got a total risk profile on here of $175. And because these are pretty tight strikes, the potential of making up to $50 on this spread, plus whatever credit is collected, and this is collecting a credit of around 46 cents. I think that this is probably a little bit complex. I might drop one of these legs because, just so I don't have all of these, but this is definitely a decent setup. I mean, you've got everything right in there. Break even 36.58, and as we saw in here on options AI on the 28th, that is the break even is actually above this expected range. So we do have an expected move that is slightly lower than that. So I would adjust that trade accordingly. Scroll back over here. I would drop the 37.50 and I'm just gonna try to just adjust this a little bit to see if I can make a trade that makes sense here. Not that that trade didn't make sense. That was a fine trade for people that want to trade in that style. This little guy collects only 25 cents. $92 risk, could make up to $100. 76%. Break even's 36.46. So similar break even. And so the question is, can I do 2 of these and then 1 of these? I'm trying to get this credit up, and then we just blow this down. I'm trying to get that break even a little bit lower. Now the break even's 36.18. This is open for a credit of 33 cents, and it's still above the expected move. So let's go back to, let's delete the 37 and change the 36 to the 3. One more over here. 36.65. Break even's now 35.72. The opening credit is 24 cents, which is definitely in my wheelhouse. It has potentially making up to $150 if it does move, and very, very clean little setup, a 132 butterfly. So equidistant 132 butterfly. But any of those trades that I just had up are acceptable. I mean, you're looking for a bearish position. These are fairly omnidirectional trades because the delta is positive. We've got a 4 delta. So if the market moves up, it's just, going into our profit zone. We may be able to use some of the credit we collected to clean this up, buy back one of the short puts, and create a free butterfly pretty easily if there was a bearish or a bullish move after placing this trade. But 17 days away, I like this setup quite a bit. Nice break even at 35.72. And the potential of, if it drops down, making a nice little trade. But again, Upstart could go back to 20 bucks pretty easily. There's definitely risk on either side. GV says USO. Okay, USO I don't love trading. Okay, for those of you who don't know, let's look at, I'm gonna pull up something else here. USO. USO is a fund that is, when you look at it over time, if we look over like 5-year, it depletes because it plays futures. So just because of the design, sorry, I pushed the wrong button, just because of the design, if we look back at the max price, the fund is always going to deplete in value. For that reason, I don't love playing it in general. There's just a kind of a steady drop in this particular fund. But it doesn't mean that we can't play it short term. So let's take a look at what the trade suggestion is, and we will see what it is. So I've got USO up here on screen, and August 18th, maybe some sort of condor on either side of the 60 and 90. Haven't fully looked at it because the stream started before I could. Oh yeah, no problem. Well, I can look at it right now while we are live. This is exactly the type of thing I love to do. So let's look over at the expected move, USO, and you're looking at August 18th, which I think is the kind of optimal. For those of you watching on Tasty Trade, we know that 38 days can be the best time to, or around the best time to play neutral strategies. I'm interested just to see what the neutral strategy is here on the 45 days. This is the August 25th. August 28th. Typically when the VIX is low, it means we go a little bit longer duration. So if we were looking at something, here's a condor, here's the 70% probability of making money. You can see these outside ranges where we've already seen some support 3 times at this lower level, right near the break even on this trade. And here's the expected move, so well within the expected move, maximum gain $72. If you buy the 56 put, sell the 61 put, sell the 75 call, and buy the 80 call for August 18th. I might go a little bit further out in this particular case. Look at the August 25th. Same, it's like more of the same. Typically in lower IVs, I go a little bit longer on these. I find that the theta decay is a little bit better, and that's just a practice thing. You learn this over time. If you've traded enough of these, if you've traded through low volatility, high volatility. In high volatility, we shorten the duration of the trades. If our mean trade average is 45 days, then we go shorter duration in high volatility, we go slightly longer in lower volatility. So I would be considering at least the 45, if not even further, for playing a condor on USO. Mike says, Jimmy Trader, seems like a good stock for a condor on Upstart. I don't know if I would trade a condor on Upstart. I wouldn't take any upside risk because the previous move. I mean, if you look at what Upstart has done, where's my Upstart position? You just have to go back to the weekly. I mean, I traded right through this move to the upside. Stock IPO'd down here in 2020, and I traded this in my trading room. You guys can go back and look at how we were putting on trades, but I did not take any upside risk. And for the reason that this was just exploding to the upside. This is a very interesting company. They're using AI to help banks make better lending decisions. So there's quite a bit of potential money to be made in this company. The management is quite strong. If you listen to their quarterly reports, if you read their quarterly reports, they're starting to make some money. But if you go into the calls and listen to those past calls, you can kind of get an idea of where the potential is with this stock and why there was so much potential during the pandemic. And why we saw that price increase so much. So for me, I'm not betting anything against Upstart to the upside. I have in the past, and I did. Again, any of my patrons, they can go back and look at how I played this last year, because when we saw this massive downswing, I did hold some short calls in these cases, but when we started to see some price appreciation, I got out of those positions because I know that once this starts to run, it could really, really go up. So I'm not saying, go long on this. I'm just saying it has potential. So it's risky, and I have to play trades that I have a strong likelihood that I'm going to make money off of. So Mike saying, howdy. Hope you're having a fantastic day north of the border. Well, thank you, Mike. Appreciate that. Always. You guys are fantastic. If I don't say that enough, I love doing this. I love that you get to join me. We get to do these streams together. It is the highlight of my week. Obviously, I get to talk to my patrons every day, so we get to trade in the chat room. And if you guys are interested in that, you can head on down to patreon.com, go over to Drawbridge Finance. Again, at the beginning of the stream, I showed you how to follow. I think that's pretty important. If you guys are looking to follow certain people, anybody, any creators, I spend a lot of time setting this up. This little follow button right over here, this is the super hidden one. If you click on that, you can actually just click follow, and then you can sign up for the emails that come out. I don't send out a huge amount. Usually I'm just making posts about my upcoming live streams. I post those so you don't miss them. They come right to your inbox. But occasionally I do some little bonus trades that I just post for free. And then obviously I have my paid section as well. So I think Patreon's really stepping up their game. It's a pretty great platform. I like it. It gives you guys full control. It's one of the things I like about it is that you can control your account. You can control how much you pledge, how much how your charges go through. That's all on your end. I have nothing really to do with it. It's like people ask me all the time if I can adjust their pledge. I'm like, no, that's you. They just send me whatever you've decided to donate to the videos. If the donation meets the threshold, obviously I give perks by letting people into the Discord chat, which is pretty awesome. That way everybody works together, and hopefully we can make some money, because that's what it's all about, making money. I see. Would you consider options on leveraged ETFs such as BOIL or KOLD, or is it too risky in your opinion? I don't particularly love doing it. I have looked at it before. The problem is that options are already leveraged contracts. So I'm just trying to think if I have anything here in where, like if you were doing like a TQQQ, why has that only moved that much today? The Qs are up. Well, the Qs are barely up. They're just flat. We're just having a flat day. TQQQ is a leveraged fund. There are options available on it. I don't think it's a smart play to play leveraged options on leveraged products. But that's just my opinion. So we get enough leverage. I mean, all we have to do is do credit spreads or any sort of spread on any product, and we're already leveraging massively. It doesn't matter what the product is. And to play options which are leveraged on top of a leveraged product, I just don't love it. I'm sure there's people that kill it and make tons of money doing that. But the other side is you could blow up an account. I personally have never blown up an account. It seems like this is like common on the internet that I'm in chat rooms and people are like, oh, I blew up this account and I did this. And I'm like, how does that even happen? I mean, like, we know what the parameters of the trade are. We know what the max loss is when we put in a limited loss strategy. You know, why are you leveraging so much? Why are you not keeping that max drawdown in check? It blows my mind to think that even happens. Now, for me also, like just from my personal experience, I never traded options before I had a $250,000 account. So now my accounts are much larger than that. I can't even conceive of having a potential like blow up. So even when I started, it was like I was very, very specific about what I was buying and what I was doing. And risk management is massively important in this game. We have to keep our capital, and we have to be able to, trade another day. So it took me quite a few years. I mean, I started trading when I was 16. I retired when I was 40, or just before I turned 40. So it took me 25 years to get to the place where I was like comfortable enough where I was able to make some money on a monthly basis that I could live off of, and to build those accounts over time. I far too often I see people come in and they're like, where do I start with $1,000? It's like, if you have $1,000, go get a job. Option trading is probably not the right thing for somebody that has $1,000, because you're either taking way too much risk or you're not making enough money. One of those two things. So although there's people that can do it, they can make these massive moves, the likelihood is that the move is going to be to the wrong side one time, and then the account blows up. That's just my opinion on it. But I'm a fairly conservative trader. I like to put on trades that have a very high probability of profit. And I'm very okay making like 15% a year from option trading, partially because my accounts are large enough to be able to consider that. IC says, thanks for your input. Well, yes, you're welcome. Good luck trading them. If you choose to trade them, I mean, like I said, there's money to be made. So you can. Jet LM, do you prefer put vertical or put wheel strategy? You know what, it really is, that's a loaded question. So the wheel strategy is a fantastic strategy in an account that I have to do. I have to hold long stock. I typically don't just wheel in a margin account. There doesn't seem to be any, I don't know why you would really. If the expected move is such that, let's just look at something. Let's look at Starbucks and just say, well, wait, why would I do one or the other? Now, in this case, if I was wheeling, then I would be looking at a trade. I would go out to say August 18th, and I would say, okay, here's my wheel strategy. Stock's trading at $99. I'm willing to buy the stock if it drops to $90. I'm willing to collect 67 cents for this. From a cash secured point of view, if you look at this profile, the max loss in this trade is $8,934. So from a math point, let's take a look at the return on capital. So the maximum return on this trade is going to be $66. Say we're going to divide that by 8934, which is the max drawdown. 8934. It's a 0.7% return over 38 days. So if we divide that by 38 days and then we times that by 365, we're going to get the annualized simple return. So we're going to get an annualized return of 7%. It's not super lucrative. Now, if I was to just do this as a spread, here we go. Now there's the spread. Same strike. I have a slightly lower probability of profit. So let me just show you how that changed. So this one, it's so close. It's so close. The probability of profit is so tight that it didn't even change. 90% probability of profit. Max return is $66. Max loss is $89.34. From a capital standpoint, this trade now has a max loss of $950, but can make $50 if the stock stays above $90 a share. Let's get our calculator out and do that same calculation that we did. So we get $50 credit. We divide that by $950, which is the risk. In that 38 days, we make a 5% return. We divide that by 38 days, and we times that by 365. So now we have a 50% return on capital. If I did this trade every single day and was successful 12 times in a row, I have made a 50% return. I've made $50 every month or every 38 days. And so that would happen, I would get about 11 trades. I would make about $550 over the course of the year. With my total max risk of $950, that return on capital is incredibly high. You know, for institutional traders, this is the way that they're trading. They are not just doing naked positions, because the return on capital is ridiculously small. Doesn't mean you can't make money, it's just ridiculously small. So I reserve my wheel strategies for accounts where I'm not allowed to trade spreads in them. You know, I have to hold stock and I have to sell covered calls. That's what a wheel strategy is for. So it depends. Obviously, it's a very, very important strategy. And the next thing you're going to say is, well, I can't sell a short put. I can't actually apply a wheel strategy in a TFSA or an RSP or like a Roth IRA. Sometimes they won't let you sell those. Depends on what brokerage you're with. But you can do it synthetically. You know, here's the synthetic position. This has the same max return of $91, the max loss $89.09. All I'm doing is I'm buying 100 shares of stock and I'm selling an in-the-money call. I have the exact same profit profile. So there's the hack on how to sell a short put in a register account. This trade can be done in any account. There's no restriction to it because there's no upside risk. It is 100% cash secured because you actually pay the money up front. You're paying $8,900 to enter, and yeah, no restriction. So I like both strategies, but the return on capital on spreads is way better than the return on long stock covered call positions, which is what the wheel is. 3D of 5. Are you still doing the delta hedge trade? Long stock, short call, rebalance daily? No, I'm not. I'm not doing it. I'm definitely not rebalancing it daily. I have one on. I have a dynamic hedge, which is, yes, it is a delta hedge. The dynamic hedge is on Roblox. I was just finding that with the daily adjustments weren't making that much money, and when the volatility started dropping, we've been in below volatility now for a couple of months. So that trade was working when the stocks were whipping all over the place and the volatility was high, and I was making some decent premium off of it. But when the volatility dropped, it just didn't make a lot of sense. It might make more sense now to actually get into it and collect the cash, because when a dynamic hedge has a short stock position, so we get cash deposited into our account, the cash balance is actually paying out at a pretty good rate. My rate at IBKR on US dollars is 4.58% right now, just on cash balance. So more and more incentive to hold cash in an account and less incentive to hold stock, because I can do a stock return with a synthetic position. So my account right now, even with some long stock positions that I've held for a very long time that I don't really want to get rid of because the tax implication of selling them is actually high in my margin account. So I'd have to pay a good chunk of taxes if I cash them out because my cost basis is so low. But even so, I have been selling off some of that stuff and trying to get out of those positions to get more into cash and just to allow myself to collect some cash flow off of holding cash, using options for synthetic positions, using things like credit spreads and honey traps, things like that to leverage my money while I'm collecting a decent amount of premium just from holding interest. You're welcome. Jet LM. Boyd says, glad to join. Do you trade INCT? I think you mean INTC. Is it on here? Yeah, INTC Intel. Oh, sorry, realized you weren't on there. INTC is on my watch list. I didn't, I was trading it last year. I had some like long positions on, and quite thankfully, one of my patrons, who works in the business, told me that AMD was a much stronger company, and we had quite the discussion about it in the chat room. And so I got out of it before any of this drawdown. So I can't even remember, it's been so long now, but about a year and a half ago, stock was trading up here. I was trading some neutral positions on it, and the market has gone down. They just haven't, with that 6 nanometer chip or 7 nanometer chip, whatever they're trying to develop, they've had a really tough time. AMD, I think, is a stronger company just in general. And I actually have a friend who just got a job at AMD, so I hope maybe he's watching right now. Ken, if you're out there, he's probably working and not watching my stream. But AMD, I think, is the stronger company, and I would be playing this as a neutral position after this run up. I wouldn't be taking too much upside risk because I think there's potential that it could continue to go up. AMD, obviously, in the AI sector, competing with NVIDIA. They've got some new chips and some new software coming out later this year. So this should help drive the stock price up. But this might be a good setup for honey trap, targeting an area down here where we're looking for a pullback close to the moving average. So let's take a look and see if there's anything that we can see on there. Again, going out to August, we're the 38 days. What if we did something really, really simple and just set up a trap? You can see how quickly these get entered because they're a pretty straightforward trade. We're just all puts and we just buy, sell, buy. So that's the trap profile on this. Looking at this is a $2,500 trade, max potential return of around $660, so about 20% if it does fall down into the trap. If it doesn't, makes $116. After commissions, open for about 120. So let's just do the quick math on that. If it goes up, let's say we make 115 after commissions. We divide that by the max loss, which is 23.83. And so 4.8% return on capital. Break even is 92.94, and I'm going to go zip over to options AI and just confirm that. So 92.94. You guys get to see all of how, this is how I function on every one of my trades. I'm using multiple sources to say where is the potential. Earnings look like that they're coming out. Why is earnings not there? But there's this little blip in the chain, which means that there's likely earnings. So I would want to try to trade past that, where you get paid for holding over it. August 18th, 99 is the expected move. So that trade is above that 99 or below that 99. And that would be falling right into the trap. The 99 move being right here, right at the beginning of the trap. That's kind of ideal setup. So pretty nice little trade. Pretty easy to adjust this as well. If I wanted to take way less risk, I just tighten up that lower leg. Now we've got a potential 50% return on capital. I've got $1,000 risk and potential $500. But if the stock goes up, I don't make as much money. So there's the trade-off. If I'm doing multiple contracts, this is where what I might do is I might play one in this setup, and then I might play one with this setup. So it depends on the account size, but the bigger our account gets, the more flexibility we have. And that's the kind of thing I might take this bigger credit on one contract and then play a couple of the smaller ones. And then I can make a very, very decent return on capital by reducing my risk quite a bit. Interesting. Thanks. And what is your preferred earnings trade? Mostly avoid earnings. I mean, I've been doing this for long enough, and I've traded all sorts of different trades. And, there's, for every win that I have on earnings, I have a loss that is equal. So it would be interesting study to go back through my trades and say, well, how many of these trades did worked out? For the most part, I don't take neutral trades anymore on earnings positions. I think if I was going to pick a trade, if I had to say, well, what's the one trade I was going to trade, it would be a Batman trade, either limited loss or unlimited loss, Batman depending. So they're a fairly neutral strategy, but I can adjust the parameters of it to really try to capture a particular move. And if it gets blown out, at least I've got a decent credit to roll it out and try to capture some sort of recovery if the stock goes down too much or up too much, either way. So that would be kind of the preferred if I was looking at something either. Or I would do, no, I don't typically play diagonals. Calendars sometimes can work out quite well. It really depends on how high the IV is. This is the thing with this type of trading. It's like there's ideally when you look retrospectively, it's easy to say, oh, well, that was the trade I should have taken. It stayed in this range or it did this and the IV compressed in this way. When earnings happen, we know that short-term volatility drops. The thing we don't know is the movement. So we want to trade trades that don't cost us much if the volatility drops, which means diagonals get a little bit sketchy over earnings. If the setup is right, they can work really well. Unicorns can perform very, very well on an earnings trade. So can double diagonals. Sometimes they don't work out though. So again, back to that. If I was to do it, I would venture to bet that I have made as much as I've lost on earnings. All right, it is 12:04. This has been an hour. You guys have been great. I'm going to push this button that says "Let's get rich together." If you're interested in signing up for Patreon, again, here's the information and at least go over and follow me there and give me a like. Thank you so much for all of the support that you guys have for watching my videos. Appreciate it. We'll see you next week, and I will see my patrons on Thursday for the members only edition. Let's get rich together. Take care.